They're spooky and they're scary reverse mortgages. What's scary is that no one can predict when to expect housing market recessions and large losses of home equity, as discussed in my previous video. So the potential of home equity losses is spooky, but a reverse mortgage line of credit could hedge against scary housing recessions by locking in that line of credit at more favorable market conditions. For example, if your home appraises for $400,000, you own it free and clear, and the housing market drops, say, 35%, which, by the way, is less than that from the Great Recession of 2008, you would lose $140,000 equity, lowering your home to $260,000 in value. That $140,000 of loss could happen in months, like it did in the Great Recession. However, a senior couple, say 75 years old, they could have locked in a reverse mortgage line of credit for $143,000 while the home was worth $400,000. But if they tried to secure a reverse line of credit after the market drop, with their home value only at $260,000, they would only qualify for $93,000. That's $50,000 less. In other words, you secured a reverse line of credit before the market dropped, giving you an additional $50,000 hedge during a recession when you can use the money. For a $500,000 home in the same scenario, your line of credit, if secured before the market drop, would be $179,000, and after only $116,000, netting you a $62,000 hedge just by securing the line of credit while the market was higher. For a $300,000 home, your pre-drop line of credit is $107,000. After the market drops, you only qualify for $70,000. So giving you an additional $37,000 hedge while for the market depression. That's the best case scenario, when your home is free and clear. However, if your home was worth $400,000 with a lien of $93,000 on the house before the crash, you would still be able to leverage $50,000 of your equity on a line of credit. But if you waited till after the market drops to $260,000, your home is $260,000, with that $93,000 lien, the lender would deny you any line of credit, $0. For a home worth $300,000 with a lien of, say, $69,000, you could still borrow $37,000 or get a line of credit of $37,000 before the market drops, but after your home drops to $195,000 with that lien of $69,000, you will qualify for a $0 line of credit. For a home of $500,000 with a lien of $116,000, you could borrow $62,000 before the market drops. But after your home drops to $325,000 and a lien of $116,000, you will qualify for $0 of a line of credit. Imagine when times are the worst that you cannot leverage your equity for cash when you need it the most. That is spooky and scary. The most critical benefit of securing the reverse line of credit is that the lender cannot rescind your line of credit when the market conditions turn unfavorable, as they did in 2008 when they froze home equity lines of credit. Because the FHA guarantees reverse mortgages, lenders cannot cancel or freeze access to your line of credit during a recession. Market crashes that erode equity can be spooky and scary. So lock in that reverse mortgage line of credit to hedge against a housing market downturn while you still have sufficient home equity. I look forward to your call.